I see the Timothy Fixed Income Fund has negative returns over the last 10 years. How do we benefit from this fund? Is it the bond yields or dividends? What do you think?
Well, bonds don't pay dividends, so they pay interest. And so the mutual fund is going to pay that interest out in the form of dividends. So yes, you benefit there. We're in an environment right now, based on what I just explained about CDs and the secondary market, that there's an inverse relationship to bond prices and current interest rates. So as interest rates go up, you've got all of these bonds that have already been issued prior, so they may be paying, 2 or 3%. New ones that are being issued right now may be paying 3.5%, 4%. So if somebody is coming into the market and wanting to buy, you're buying cash flow whenever you're buying a bond, because the cash flow doesn't change over the life of the bond, and then you get your original principal back at the end of it. So the way that you adjust for changing interest rates is that the price of bonds changes as interest rates change. So in a rising interest rate environment, which is what we have seen in a very, very big way this last year, we've seen yields go up. We've seen the interest rate go up because of what the Fed is doing with the Fed funds rate. And so we've seen bond prices drop. So that's why the value of your bond or bond funds are going down. But we still think that they're a good part of an overall diversified portfolio. They will do better under different market conditions, and we think that those market conditions are going to be coming sooner or later. So diversification, when you have a diversified portfolio, you're going to always have something that is not necessarily doing well. But what you should have over time is that all of those things should work together to give you a good and much more stable experience than what you would see if you were not diversified.